Boss Resources has announced they are moving forward with their option study that is assessing the most appropriate technology to recommence uranium production at their Honeymoon project in South Australia. The purpose of the study is to choose the most appropriate processing technology that will achieve the lowest operating costs, but more importantly, minimise any potential startup issues. Boss has also confirmed that when production does recommence, they will initially utilise existing infrastructure before gradually ramping up production over a number of years. This strategy reduces the initial capital cost for production to commence, which in turn reduces dilution, whilst profits generated from the project will then be used to expand production. So given this announcement, the current size of the resource, as well as the exploration potential where drilling will shortly commence, we have reassessed the key assumptions in our model, which has resulted in our valuation increasing to 27 cents per share. The key assumptions in our valuation that we explain in further detail include the production rate and mine life, the uranium price, as well as our operating and capital cost assumptions. The major difference in our current valuation compared to our previous assumptions is that we have now increased the mine life to incorporate the entire current resource, as well as increased the long-term production to 4 million pounds per annum. We have assumed that production is gradually ramped up over a number of years to ensure there is sufficient cash flow from the operation to pay for the additional capital requirements. The uranium spot price has struggled during 2016, and whilst our model has assumed a price of $60 per pound, which is around double the current price, we believe Boss, or any other uranium development asset for that matter, would not consider commencing development without the price being around this level. We also note a number of experts have forecasted the uranium price will reach our forecasted level by around the year 2018 due to supply and demand fundamentals. However, given the historical volatility, we have examined a range of different uranium price scenarios, and we note that for every $5 per pound change in the uranium price, our valuation increases by approximately 3 cents per share. And finally, to determine both the operating and capital costs, we reviewed the historical results of the operation, reviewed peer costings for other ISL operations globally, as well as discuss potential costings and timings with management. The graph illustrates both the capital, C1, and all-in sustaining costs for each year of the operation. It should be noted that the operating costs decrease significantly as production is increased. This is to be expected as the majority of costs at an ISL operation are fixed. Therefore, as production is increased, the fixed costs are spread across a greater number of production pounds. But as there is a degree of uncertainty regarding our assumptions, we have examined a range of scenarios. And as shown, on all scenarios, including the triple downside, our valuation is still higher than Boss's current share price, which highlights both the robustness of the project, as well as the long-term upside potential in Boss's current share price.